Natural gas markets have experienced another decline throughout the week, which makes a considerable amount of sense, given that we are in the summertime, a period that is generally slow for nat gas. We recently had a heat wave that drove the market back up to the $3 level, but I now believe we will gradually erode any support and could potentially end up closer to the $2.30 support. The primary downward driver is the continued recovery in Appalachian gas production. Since the beginning of July, flows through the Mountain Valley Pipeline have significantly increased. Month to date, gas flows have averaged nearly 1 billion cubic feet per day, up from 0.7 billion during the last week of June. Recent production gains in Appalachia also follow EQT's announcement that the company had begun reactivating earlier deferred production, a process expected to be gradual. Meanwhile, there is positive news for the natural gas market. On Monday, a federal court sided with 16 states to lift the administration's pause on new permit approvals for LNG exports. In January, the Biden administration, responding to climate concerns, paused approvals for new LNG export facilities. Nevertheless, a U.S. district judge from Louisiana issued a stay on Monday that immediately lifts the U.S. Department of Energy's hold on LNG export terminal projects. His order, hailed as a significant victory for the fossil fuel industry, does not lead to any LNG projects being approved right away. Instead, it simply resumes the approval process. Overall, considering the rising gas flows to LNG export terminals and the fact that the nat gas market typically experiences a boost towards the end of summer, possibly early fall, gas prices are expected to increase toward $3.50 around November-December. This is as people start preparing for the idea of winter, which naturally drives higher demand for natural gas. The short-term forecast for natural gas seems bearish due to the various factors previously mentioned. Natural gas prices might present an intriguing opportunity for some dip buying, although, for now, this would appeal only to more adventurous traders. Traders will wait for the opportune moment to buy the dip, which could result in natural gas prices initially bouncing back up to $2.50. The 50 and 200-day moving averages are the initial hurdles on the upside, near $2.53, closely followed by the main resistance at $2.60. Once prices move above these levels, the pivotal resistance near $2.80 becomes crucial. On the downside, the support level at $2.30 may offer some buying opportunities. Please like, subscribe, and comment to support the channel. See you in the next one.